So first up, let's talk about the fixed income opportunities because, for a long time now, investors in debt mutual funds have seen very, very scanty returns. But we've seen, rate hikes come through from the Reserve Bank, and probably it's not the end of it. There could be more ahead. So what does it mean for fixed income investors? What are the kind of opportunities, and in which funds could there be some sort of, positive outlook for these investors? DP Singh of SBI Mutual Fund joins in first up. Hi, Mr. Singh. Thanks very much for joining in. I wanted to begin by asking you about these shorter term funds because, the consensus is that that's where, perhaps the biggest opportunity lies. So, what is it that makes it ideal for an investor to look at these kind of funds?
Yeah, so Mera, thank you very much for having me in the show. And as you rightly said, yes, in the shorter term, why we are saying that this is a big opportunity because the yields have moved up very, very sharply over the last 1 month to 45 days. With the interest rates going up globally and the RBI also showing this thing by increasing the repo rates and all kinds of rates during the last policy. And if we look at the yields have touched as high as 7.6% for 10-year yield. And in the shorter term also, there's a is very, very steep movement in the interest rates. So all those funds which were giving 3.5%, 4% kind of return or 3% kind of return, those have now can see a return higher than 5.5%, 6%. So those are the yields which are available there. So it becomes very, very ideal as the option for the investors who are having a very short to short term kind of horizon to park their money in these funds. Why we are saying so is because as of now, it is becoming extremely difficult to take a whole hog long term call because the interest rates are still moving up. So, of course, we want people to put some money in the long-term funds, long-term duration funds as well. But most of the opportunities are available in the shorter duration funds.
Okay. This advice, regarding the shorter term funds, is this for new investors who are looking for opportunities at this moment, or even for existing investors, those who might have invested in other kinds of debt funds? Should they be redeeming from there and moving here? And, what about the longer tenure capital, those who want to remain invested for, say, 4-5 years?
So, for the longer term investors who are already invested, my suggestion will always be to remain invested because most of the damage which was to happen has happened.
Okay.
I don't think that the yields will go very, very steep from here on. And if they redeem and they switch from these funds at this moment to shorter term funds, then the notional loss which they are saying because of mark to market valuations, they will make it permanent and they will not be able to make up for it. If they are long-term investors, they should continue to remain invested. But for the new investors or the new money which are there with these investors, which is to be allocated, there my suggestion will be to go in for a shorter term fund because there's always a lag. Today, even though the interest rates have moved up, the other avenues like bank deposits or fixed coupon instruments, there the yields are still not catched up with the higher. They have not caught up with the rates which have moved up. So this is the opportunity 1 to 2 months window where one can look at allocating more and more funds to the shorter duration funds or floater fund to say so. If those floater funds are also actually positioned in not very long term. If there's a floater fund and a position in a very long term kind of thing, even that will not do well. Any fund which is positioned as 1.5 year kind of duration, those will be very, very good for the investors to put in at this point of time.
Okay, so by this we mean, the liquid funds, overnight funds, ultra short duration funds. So if these are the kind of funds that investors are looking at, what other debt funds would be required to, sort of complement them and complete the debt portfolio?
Oh, a little higher than that. Not only liquid fund and overnight funds. I will talk about the money market funds, which are going
Okay.
to be hot favorites. I feel so because those will give up and down, and the yields on those funds have reached around 6% plus kind of returns, and net to expenses. those should be, even if there's a very, very short mark-to-market loss, those should be giving the 5.5% kind of return can be generated. Of course, there's a little mark-to-market risk, but those are the funds, the money market funds or low duration funds, or these are the funds which will like people to put in money for 3 to 6 months.
Okay, and all the way, by the way, for those who are watching, from overnight funds to money market funds, these are all funds which have various, durations, from overnight, of course, being, overnight, one day, and all the way to money market, which is 1 year, right? So, you know the time
Yeah.
period that we're talking about. But, and Mr. Singh, I'm not trying to suggest that investors should try and time the interest rate cycle, but, experts are saying that further hikes cannot be ruled out. They should be expected. So therefore, going forward, how should retail investors look to create their strategy? I mean, what do they expect from here on?
So Maya, you have to keep one thing in mind. Markets are very, very smart and they factor all the future rate hikes already in advance. Even now, when interest rates moved up by 50 basis points, yields have not moved up by 50 basis points because a lot of it was already factored. Even now, any further hike of, say, 30 to 50 basis points is already factored or will be factored over a couple of days. I mean, that's something which is going to happen. So don't wait for that thing to happen. That let it see hike happen, then we will do it. That's not the case. But one thing is very clear: RBI is having both the agendas, growth as well as inflation are the two major areas. And inflation looks like peaking up at this point of time in the country because other countries are having very, very big the problem of inflation. We are having, but not that much. That are not that high. I mean, even if you look at the developed countries like US or UK, when say today the inflation is at 10%. So we have not seen those kind of inflation rates in our country, and these kind of inflation rates are unheard of in these countries. So that's what it is. But I think I'm not suggesting that the interest rates have peaked up, but it's not that these will further go by 200 basis point or 300 basis point, nothing of that sort. That's my strong conviction is.
But wouldn't a floating rate fund serve the purpose of every investor so that we can leave it to the fund manager to do the heavy lifting?
See what happens when then there, unless and until there's a definite announcement by the fund manager that he'll keep the maturity at a particular level. See, these floating rate funds also can give you shocks. So if it is positioned as 1.5 year kind of the period, then it's fine. But otherwise, even if it is reset happens after 6 months, during those 6 months also mark to market loss can happen. If its floating papers are kept at a lower duration, then floating rate definitely makes very, very good sense. But
Okay.
even if the floating rate instruments are of high duration, even then the mark to market loss will be much higher. But I don't think the overall size of floating funds is so much that it can absorb too much of inflows. And see, even the floating rate instruments are not available. I
Okay.
mean, which can absorb this kind of demand from the investors.
Okay, fair enough. So far we have spoken about the impact of the rate hike. The other aspect of debt funds is the credit, right? So one aspect is interest rates, one aspect is credit. Now, of course, these shorter duration funds all the way up to 1 year, there is not much danger, of credit defaults because by and large they invest in very, very safe instruments, AAA, government bonds, etc. But, Mr. Singh, given the tough operating environment for corporates, do you fear that, going ahead, there could be some sort of defaults? I mean, for credit, what is the outlook?
No, I don't think so at all. Because see, one thing is that the issue is of the high interest rates. As far as demand side is concerned, there's no dearth of demand. Consumption is growing. That is why the inflation is, and there's no issue, especially to the kind of investment which mutual funds are making. There's no issue on the cash flow side. Cash flow is very, very strong. Other things are strong. As far as defaults because of the operating problem is concerned, I don't foresee any such thing happening in the shorter term. I mean, there's no such case for having any such fear in mind.
All right, Mr. Singh, thanks very much for joining in and for explaining this to our viewers. So basically, the big opportunities in the debt space currently lie in the kind of funds which invest in up to 1 year duration papers, and that is where you can look to make your fresh investments. With that, we're going to take a very quick break. Up next,